Well, hello everyone, and welcome to a slightly different 12th episode of our FMI broadcast. Before we begin, I just wanted to remind everyone that if you'd like to ask a question, please use the Q&A functionality at the bottom of the screen. Don't use the chat, it's likely to get lost. So post your question in there, and then hopefully, if we have time at the end of the session, we'll answer as many of them as we can. So this has been one of our most popular FMI broadcast to date in terms of registrations, and I imagine a lot of that had to do with our guests. So today, Martin Kyle from Payments Canada will be having a discussion, or fireside chat as they are often called, with Kimmo Soramäki, FNA's founder and CEO, and they'll be covering the application of digital twins within payment systems. So Martin is the Chief Information Security Officer, the CISO at Payments Canada. He's responsible for the organization's corporate security program, including both cyber and physical security. He also has a deep background in technology development, implementation, and oversight. Kimmo, as I said, is the founder and CEO of FNA and co-author of the book Network Theory and Financial Risk. He started his career as an economist at the Bank of Finland, where in 1997 he developed the first simulator for optimizing intraday liquidity within interbank payment systems. Later, during the financial crisis of 2008, Kimmo advised several central banks on modeling interconnections and systemic risk. And then this work led him to found FNA in order to make systemic risks visible and financial market infrastructures and institutions more resilient and efficient. So, without further ado, gentlemen, thank you very much. Thank you for joining us. I'll hand the floor over to you. Let's not waste any time for you to begin the discussion, and then I'll come back at the end to run the Q&A. So, thank you again. Over to you.
Well, thank you very much. And I'm very delighted to be here with Kimmo today and to talk a little bit about the value and benefit of digital twins in financial services. Now, Kimmo, I'm not sure if you knew this, but I have a little bit of background supporting software systems, developing software systems for the engineering sector. And in civil engineering, digital twins are used to provide simulations of buildings and other works because it's very cost effective to run models and assumptions on a twin in that world. But I was wondering if you could briefly describe and explain what a digital twin is in the context of financial services.
Sure, and great to be here as well. Nice to chat with you again, Martin. So the concept is really exactly the same. Instead of like in the, let's say, engineering, you would build a digital twin of Rolls-Royce builds digital twins of the engines they build. So we build digital twins or replicas or simulators of financial market infrastructures like payment systems. And Anthony mentioned that when I started working in '97, that sort of got me into this digital twin world immediately by building that simulator at the Bank of Finland. So the digital twins really intend to replicate the behaviors and the actions. So you put in the same inputs into the digital twin as the real system, you get the same outputs. The difference, of course, is that the real system is maybe geared towards resilience and real-time operation, while the digital twin is configured for ability to run different types of scenarios very quickly, test different data inputs to it, maybe like synthetic data sets, but the goal is the same, is to understand how the real system will behave under different circumstances without having to actually test the real system in different circumstances and learn from that.
Right. So it seems like, you would have to make some concessions or modeling assumptions in a digital twin. Can you describe what those might be or whether they exist at all?
I think the fun part, of course, is that a lot of these payment systems are actually software themselves. So if you build software to replicate software, you know exactly how that software works. So for example, the settlement engine part, we can replicate exactly because a payment comes, how it is processed, are there some liquidity saving mechanisms, is it netted? Like the economic outputs should be exactly the same, as well as the how quickly it's processed from a sort of risk controls perspective. Is it delayed because there is not sufficient liquidity? I think those are things that we can exactly replicate. And when we've been building these digital twins, the goal has been also to design better systems so that those sort of aspects around liquidity and delays can be optimized. Of course, some other aspects like maybe delays that are caused by sort of technical factors, by how quickly the real system processes things, those we can approximate and model and actually come up with requirements how quickly the real system should be able to process things from the system's sort of like operational efficiency perspective. But those are things that we can only approximate, is because we don't know exactly on what gear like the system might be working on, and how congested it is. Are there some background processes running that take some of the power from the computer system? But I think the economic outputs we can exactly replicate, but the operational maybe outputs we can approximate or model.
All right, so if I can summarize that, the inputs are the same and the outputs are the same, but the clearly the production environment is different. The resource consumption in production on the infrastructure is different. So the digital twin is really providing a rapid simulation for the same inputs and the same outputs. Is that about
exactly? Yeah, and then you can also vary the inputs, because in the real system you only get the real inputs, but maybe in the digital twin environment you want to actually test would the real system be able to cope with 10 times the volumes or some peak volumes. So you can do this type of different scenario analysis to understand how the real system would perform under different circumstances that you don't find in reality or you don't have historically data about.
Right. So we talk generally about digital twins in financial services. How are they relevant? And certainly, at Payments Canada, we understand how we use a digital twin on a clearing and settlement perspective for high value payments. But how can a digital twin be helpful for a bank, for example, as opposed to a financial market infrastructure?
Yeah, so I think even in the financial market infrastructure sort of space, there's lots of different use cases depending on the life cycle where you are at the system design or operation, and maybe we can come back to that later. I think also the financial market participants, the banks, could use you could play against the digital twin of the infrastructures that they participate in. For example, a bank could see sort of what if we settle a little bit later payments in links or earlier, what kind of outcomes could that have to us, because maybe we have access to the digital twin of the actual infrastructure. But they could also start building digital twins of their own operations and then start to do in a way the same type of analysis of how could we maybe optimize processes. They could benchmark against the digital twin to see if the digital twin is the theoretical operation of the system, and how does our actual operation benchmark with the digital twin. So the same type of use cases around design, scenario analysis, benchmarking, change management, and optimization that a financial market infrastructure might want to be doing. So when we are working with banks and optimizing their sort of payment flows for saving intraday liquidity, our approach is actually to build a digital twin of the bank's operations. How are the payments processed today? what are the outcomes of the decisions that they make around timing and venue and the Rails perspective, to replicate what do we see today, and then do some policy changes, apply some algorithms, apply some optimization to show like what would be a more optimal way of processing their payments that are on their own behalf or on their customers' behalf. It really allows you this bench to start to understand how the system operates today, benchmark to the reality, and then start to optimize so that you can, in the case of this intraday liquidity optimization, save substantial amounts, multi-billion-dollar amounts in intraday liquidity or credit lines that you need to extend across the group.
Right. So you talked a lot about intraday liquidity, and when you're building out a digital twin, who are the departments that you would typically work with within a financial institution?
So they would be in a let's say it's in a bank, it would be the treasury mostly, and cash management, payment operations. Within the financial market infrastructures, within the payment systems, it might be the product when they are building or designing new features to the existing system, or it might be risk when it's considering different types of stress testing on the infrastructure, or understanding different types of cyber attacks, how they might play out, and how the system might be more resilient against those types of attacks when they are simulated against the digital twin. I think those would probably be in IT, of course, from an IT perspective, but I think the product and risk would be the key stakeholders within a payment system, and treasury within the banks.
Within the banks, right. I want to look under the hood just a little bit here, Kimmo. With a digital, when you create a digital twin, is there some type of unique, technology or research that you've done that differentiates a digital twin in financial services from other types of simulation software?
Yes, so I think simulation is always a little bit, it can be understood in many ways. It could be simulations about the data. You could think about Monte Carlo simulations. You could think about agent-based modeling simulations. You could think about when we talk about simulations, we usually refer to the replicating the engine, how everything is being processed, not necessarily, for example, simulating the connectivity of the banks, how the messaging takes place. So that's usually not when we talk about simulation, but that could also be considered as a simulation, simulating the connectivity of the banks to the financial market infrastructure. But we usually think of simulation as the settlement engine, and decide the decisions how payments are being processed by the settlement engine, and then also how the participants are deciding to maybe put the payments into the payment system, and then we get very quickly into what is called like agent-based modeling or agent-based simulation, which has a relatively long tradition of research of building these types of simulations, where you look at the emergent phenomena that when these banks make independent decisions around their how they put payments into the system, and then there is some system level behavior that emerges as an outcome, which then the participants experience as a liquidity usage, because liquidity is a network problem. If I make a payment to you, you now have this money to make payments to others. If I don't make a payment to you, you might need to use your own liquidity to make the next payment. So liquidity circulates many times in these payment systems, and it's very sort of complex dynamics. There's research on like complexity science, trying to understand all these interdependencies and modeling them, but it gets very difficult. So therefore, quite often what we do is in order to understand how these complex systems behave, we simulate them, because it's not possible to analytically analyze systems that have so many moving parts and everything depends on everything. So the analytical, I think, solutions have been developed more for like very toy models of few payments and interactions on those, but how real systems with hundreds of thousands or millions of payments and liquidity that is circulating within the system. I think the only way to understand that is to simulate it.
I'm going to pull on a couple of threads there, partly because I'm interested, and hopefully the audience is interested in it as well. You talked a little bit about agent-based models and how a bank might be one of those agents in the model in an ecosystem, a financial ecosystem. And each of these agents typically have a few set of rules that determine their behavior, or each agent in a classical agent-based model would have a set of rules, and each of these agents then become autonomous, operating within the constraints of those rules. And then you talked about something called emergent phenomena. And could you describe what that means in the context of financial simulations and digital twins? And what type of phenomena might you see that emerges when you have multiple agents operating autonomously against their rule sets?
Yeah, so we actually used to do a lot of research on this back when I was at the New York Fed, and we started looking at first of all, the topology of FedWire using network science to understand like how banks are interconnected in the FedWire system, which actually kickstarted a lot of the research on analyzing different types of financial sort of networks that we see in real life, and was also the reason that I ended up setting up the company Financial Network Analytics, aka FNA. But the other branch of research we did back then was together with the Sandia National Laboratories, and we were building this model called Loki, which was to simulate attacks on critical infrastructures. And this sort of branch of research was started after the 9/11 terrorist attacks, when, of course, large parts of the financial system got disrupted, and the goal of that research was to understand better how these types of disruptions would happen, and we did a lot of research also on like maybe there's a liquidity shortage, how does the system perform then, and showed that like it becomes actually chaotic, completely unpredictable. So that's an emergent phenomena of like a system that has very little liquidity. Like then you don't know anymore like how the system will operate, because once one payment gets made, it allows a chain of others to be carried out. Sometimes those are also referred to gridlocks, and those are all the situations that central banks don't want the payment system to be in this completely unpredictable states where and gridlock states, because then like the backbone of the financial system doesn't work any more smoothly. I think that's the bottom line. So on the agents, so the simple rules that the agent might be playing, might be doing, might be something that they've done in the past. I think in CHAPS, also in LVTS, for example, holding bilateral limits, for example, against each other, and looking at I'm not going to go more than 50 million deficit towards you. I want to get some payments from you before I make payments to you. And sometimes these are also institutionalized within the system, that you can actually set these things up. But those could be just simple behavioral rules that the banks are doing in order to maintain their own sort of liquidity and not make all their payments immediately, but wait for some incoming funds to sort of balance the in and outflows of their payments. So there's lots of different strategies that banks do that, or software that they have operational on their own side, is to throttle payments. I know I need to make this payment, but I'm not going to make it yet because I'm waiting for some incoming funds before I make it, so that I don't use so much of my liquidity. So these are all these different like behavioral rules. But the behavioral rules actually might be, in fact, softwares, right, that operate it. So what we are simulating is this how all these softwares, when they're interacting with each other, what is the outcome of that? And I think that brings us to this interesting idea that when the financial system is getting more and more operated through software, it actually becomes a software system by itself. And in order to test that, like do unit testing and like integration testing of that complete financial system, we need actually the digital twin already also from a sort of like a financial stability and a resilience perspective to understand how does the system work as a whole.
Right, and of course, if you're trying to only simulate a financial institution over here and one over here, you're not going to get that complete picture unless you have, a system or a digital twin of the system where each of the institutions are components within that twin and operating autonomously.
A good example was when 2013 we were working together with the Bank of England to design the liquidity saving mechanisms for the CHAPS that is currently still in place. And before those new features went live, the Bank of England actually ran together workshops with the sort of like treasury groups with the banks to show them that, hey, if you just put the payments as you did historically, these are the outcomes for you. And then the banks would say, if that's the case, I would probably settle some of these payments earlier and some of these later. And then they would take the input of those agents into the simulation and run it again and show them, if you do that, then this is the outcome. So that allowed, in a way, to do agent-based simulations with the actual agents. And the actual agents actually then knew on day one how the system will actually operate and what will be the outcomes of their actions. So they wouldn't, for example, hold back payments because they're worried that they will otherwise use all their liquidity and not be able to make payments because maybe other banks are not making payments to them. And if everyone does this and is holding back, of course, no payments get settled because no one gets liquidity to make their payments because their payment ability to make payments is dependent on them receiving payments from the other banks. So it allows you to get through that in a way that chicken and egg problem of getting everyone on the same page, the agents, and actually then get everyone convinced about sort of the collaborative outcome and de-risk in a way the live going of that system.
All right. Well, thank you for satisfying my curiosity about how agents can be useful and what emergent phenomena might appear as you simulate or as you work through the models of these larger ecosystems. Another thread that I wanted to pull on in your previous response, you mentioned that payments in particular have a directionality and they are modeled using a network. And I wanted to understand why modeling, first of all, what is modeling, network modeling, and then why is that beneficial, or what's the advantage to that through versus other traditional means of modeling?
Yeah, so that's an excellent question. I think when we started to when I built the simulator in '97, I was looking into lots of different like theories, queuing theory, how do I describe this complex system of payments, how they're getting processed. We had the ability to simulate and get the outputs of those simulations, but in a way I was lacking that understanding what happens there within the system, what kind of chains of settlement are taking place, that this payment allows now that to settle and that to settle and that to settle. So then I think around 2004, there was a lot of literature books on network science, sort of popular science books around the connected and 6 degrees of separation and so forth. So then I said, maybe we could actually say that the accounts or the banks are nodes in a network, and the payment that they're making, we can aggregate into links, and then we can start to, first of all, visualize that network and understand it. And identify central players there through network algorithms to identify central players that are connected to very many other important nodes, and use algorithms like Google's PageRank to identify the most relevant nodes in that large financial network, and sort of in a way tying that ability to understand the system. And then when you start to see these visualizations of network visualization, that's how at least I always think about the system. I have that visualization in my mind when I think about the payment systems. I think it sort of it makes it a little bit more concrete. And then from a modeling perspective, you can then start to consider these nodes as agents and put some behaviors to them. And you can say that there's a relationship, so I can draw new payments to that relationship. So you can use it to start to generate like future days of data that is very realistic from the network topology perspective, is who is interacting with who within the network, because it's not just a random network. Banks are not randomly connected when you start to create synthetic data. So I think it's very relevant for the creation of synthetic data sets, is to understand that topology, like smaller banks interacting with the hubs, not so much with other smaller banks. There's quite a lot of research on these different types of topologies of identifying core periphery structures. Core banks tend to circulate liquidity within themselves. Periphery banks take liquidity on one day, give liquidity on another day, depending on their sort of a client in and outflows. But there's a very complex sort of like structure that payment systems have, is on how banks are interacting with each other, and that network science and network theory will allow it to be able to measure that and then replicate it in synthetic data sets to make them more relevant and accurate.
So building on that foundation of research really helped propel these models and ultimately the twins forward. So thank you.
And then maybe one more aspect of the network is that a lot of these liquidity saving mechanisms or algorithms are based on network science. So that in order to optimize liquidity, you need to actually understand the whole network, how you can, like, there might be triangles there that could be netted out. So a lot of these sort of like underlying mathematics to optimize liquidity are based on network science. Not only the visualization, understanding, but also the optimization. They're based on graph theory or network science.
Right. Yes, I remember a recent episode of Freakonomics where they talked about a market that operates without money, and it was the organ donor market, and it only operated successfully when there was a network understood, and where a chain of donors could actually enhance the transfer or the exchange of donated organs.
So with algorithms identifying those chains and then recommending those chains. That's
correct. Yes. Yes. So it's very useful. I mean, network science and topology and graph theory is very useful in many sectors. So thank you for explaining why it's useful here in financial services and the use and development of digital twins.
I once did an experiment, like I think it was the Swift Operations Forum in Amsterdam many years ago. I had an audience of 300 people, and one of the Swift people got the idea that why don't we do like a little experiment and give them like little tokens, like they were like these little stones, and put them on the chairs, and then I asked everyone to start exchanging these tokens. And I had somewhere, like some chairs had these instructions: don't give anyone tokens, only get them. So that was sort of like someone bank having an operational failure and becoming a liquidity sink. And then I asked after a few minutes, how many tokens everyone has, and there are lots of people with no tokens left, and a couple of people with lots of tokens. And then all the people understood that it could be that something that is very far away from me in the network could affect actually how much liquidity I have, because there's this operational failure in some part of the network, and it just made it clear that in a payment system or a financial system, you're part of a large network, and something that can happen very far away can have actually very fundamental outcomes to you that you have no visibility of, because you only see your direct counterparts or who you're dealing with.
Right, and I love that. I love that simulation you did with the tokens, because it's very physical, right? And
Exactly.
it makes it very clear what you're trying to improve, which is the financial stability of that system. Certainly the operational failures that you talked about in that example, those can be caused by a number of things. And certainly within my discipline, I'm worried about, cyber attack, and whether that in itself can cause an operational failure. And, one of the things that we worry about from a system level is the smaller financial institutions who may not be regulated as much, and may not have as many resources to protect their operational resilience. Even if a smaller institution succumbs to an operational failure, that has a cascading liquidity impact on the whole system. And I think your example there with the physical tokens demonstrates that as well.
The first and the second round effects that you only can actually evaluate and measure once you start to simulate it.
Do you want to, talk a little bit more about those second and third round effects? How those appear within a digital twin system, and what your experience is with that. Often we think of a financial system as the large players, right? And because most of the payment volumes and values will go through the large players. But what do the digital twins tell you about the importance of the smaller players?
Yeah, actually, I think we have quite a bit of work on what we call RTGS stress testing, because that's also required by the financial sector assessment programs by the IMF to be able to stress test RTGS systems. So we've been working on that quite a bit over the years to provide these facilities to run different type of scenarios of different types of failures within the large value payment systems. We also developed a few years ago with Samantha, who is our chief scientist, a measure called sync rank, where we, in a way, we don't simulate it, but it's an algorithm that can very quickly calculate which bank would create or which account would be the largest liquidity sink based on the liquidity circulation within the system. So understanding how quickly would if you pull the plug, how quickly would the liquidity sort of from different points of in the network get sucked into there. And that, of course, would be the most systemically important bank or account there, because it would suck liquidity quickest. And it, of course, depends on the type of day, whether you have a lot of incoming payments from banks that have a lot of incoming payments. So the directionality of that flow is towards that bank versus on some other day it might be going out. So the which bank is the most systemic on a particular day depends on the day. A large bank might be on some day there might be no impact, but on another day when the flows are different, there might be a large impact from that failure. So the second round effects would of course be that someone who is not directly associated with that bank that has that cyber attack or operational failure or whatever, also has some negative consequences, can't make payments because they don't have enough liquidity, payments get delayed, their liquidity position is completely different than what they forecasted, they have to go out and get additional funds from the market, would they get those funds from the market and so forth, to understand these type of of scenarios through modeling.
Great, thank you. We're going to jump back onto the digital twin track here, and I know I took you through a few questions that satisfied my curiosity and hopefully piqued some interest from our audience. Just a reminder to the audience that we will have questions and answers towards the end of the hour here, and if you can put your questions into the Q&A panel, we'll be able to curate them and see them better than in the chat. So Kimmo, data availability is a big problem for some FMIs, and I guess once the digital twin is ready, what data could be used for the purpose?
It could be the historical data first, because what we would like to do is that we would like to show that the digital twin actually produces exactly the same outcomes as what we observed historically or in the past, with the same inputs that we had in the past. And the inputs usually would be the payments, individual payments, sender, receiver, value, date, time, and then the account balances, limits, constraints, and so forth, whatever we need from a sort of like a risk controls perspective that payments are settled. Usually, like these type of things are not necessarily well documented in at least in our experience how the system works. So quite often it's also a little bit of detective and investigations and the interview work to understand how does the system actually work before we can replicate it. But the first step is using historical data, building the digital twin software on our platform, and then testing it against the historical flows. If you don't have historical flows available, but most would have, but you might want to, or maybe those are hard to access through legal sort of hurdles or operational hurdles. We most often actually do synthetic data sets, or maybe it's a system that you're designing that doesn't have any history. It's a new system, and your assumption it would attract these type of volumes and these types of payments. So we have different algorithms to develop synthetic data sets from different levels of information that you have available, like from just very simple saying that we have 15 accounts and the total value of this, and make it look like like make it look like chaps, or make it look like a FX settlement system with the 3 currencies. So you can start with the very sort of abstract information to create the synthetic data set, or you can then start with very granular information, actual exact payments, but you say like, hey, can you create the synthetic data sets that have 10 times the current value, twice the participants, to create these different types of potential future days. So I'll always say the synthetic data sets are, so you have a historical data sets, and then you have future data sets. How might the system be running into the future? So when we were doing simulations, I think initially with the Payments Canada, I think we had 30 days of historical data, and then we were creating a large number of potential future days based on that 30-day historical sample.
Right. So we've got historical data and we have synthetic data. And you kind of touched on some cases where there's a bit of a hybrid, so how can you take historical data and make synthetic data out of it?
Yeah, so usually actually most of the time we do nowadays do both. So we always do the synthetic data set because it's just easier to work on it on cloud environments and sharing information. It has still the sort of the same statistical characteristics as the real data, but doesn't have anything that you would be able to like use from a confidentiality perspective wrong. So there's different types of algorithms that we use. The simplest one would be just like sampling things. There could be some algorithms to guess what is the sort of the network structure of the system. So one would be to understand the network structure from the historical data and then start creating similar type of structures with a little bit variation going into the future. But there's gets quite complex very, very quickly. But
Right.
I think sufficient for here is that there's different methods depending on what data is available to create different types of synthetic data sets. I think we've created synthetic data sets also with one CLS project. We created synthetic data sets for all the major RTGS systems of the world. And we actually sort of vetted them with most of the central banks. Does this look like your payments data? And they said, yeah, it looks very similar. So
there in that project that you're talking about, networks of networks of networks.
Yeah,
so
exactly. Yeah,
it's a very meta.
yeah.
Very,
So evaluating the what would happen if all the CLS payments were settled in the RTGS systems instead of being netted in CLS.
great. So we're hearing a lot about new innovations. Central banks have been working quite a bit on CBDCs, digital currencies, etc. What are the applications of digital twins in this area?
I think they're in a way exactly the same. So we've created a couple of digital twins of national retail CBDC systems, and we have, I think, 2 papers out on that. There's actually a very recent one where we calibrated a retail CBDC for the Spanish sort of payment system and sort of consumers, and looking at what would happen and what kind of incentive structures you would need to have in place in order to get the adoption for retail CBDC in Spain. I think we did another one earlier where we calibrated it to Germany. The intention really with this is to you can use digital twins for a lot of, like I said in the beginning, for different where you're in the cycle of whether you're designing it, the system, or testing how it would work, or if you're launching, if you're running it in parallel to benchmark it, or do change management or do optimization. So of course, many of these retail CBDC projects are in the stage of thinking how would a CBDC look like. So what we do is we actually create the whole ecosystem in a digital twin, and that gives us a lot of questions that we need to answer, because otherwise the whole software will not run. And those questions are exactly the ones that I think are very important to know in advance when you're designing that whole CBDC, and put to make decisions around who can use it, what kind of use cases, are there going to be limits, is there going to be remuneration, is there going to be different types of programmability features, how is it all going to work, and you can test that very safely in that digital twin environment before you go out and start to build it, and you have in a way all those questions answered before, they don't come as surprises during the build phase anymore, because you already in a way build it once, but you just build it in a digital environment, and then you start building in the real environment, and you're much more prepared. I think those projects are going to be faster to develop, because you have much better sort of RFP designed, because you've already built it. So that feeds into having a good RFP, because you've thought out all the things that I need to decide upon when I build a CBDC.
Right. Just a question that came to mind here when you explained kind of that process of building the twin, understanding the network impacts and flows, and then going to RFP, and then building the real system. Have you found that once a system gets implemented with its, all of its various controls, operational controls, security controls, its performance constraints, its infrastructure that it sits on, it's all of these different, conflating factors, if they end up changing, let's say, the prioritization of payments or the optimization of liquidity because of all those constraints, are you able to go back to your twin and then update it in a way that matches
I think you would want to do it the other way around. You would want to first do the change in the digital twin, see what is the impact of that, and then maybe you would actually do a couple of iterations, because you would notice that the thought you had how it's going to work, it's not exactly how it will work in the context of that complex system. So in a way, you would whenever you do a change, you would want to do that change first in the digital twin, run it through these different scenarios. What happens if we had 10 times the volumes? What happens if there are different types of days with different market conditions, different flows? Is it also going to be okay, during those conditions? Because we have had none of these are, I think, are public, but we've had many times with the large financial market infrastructure cases where a change has been made, and then you find out later that caused some problems down the line. So therefore, I think many of the biggest ones now do have digital twins built themselves, and some of the FMIs that we have built those digital twins have actually found a lot of bugs in their existing systems proactively, which is a good thing, because you find them proactively rather than find them because they cause some problems later. So it's also in a way to make your own system more resilient. Is the process of replicating it in another software. You'll find corner cases that you hadn't maybe thought about, or a lot of these infrastructures are results of 10-20 years of little tinkering, and not good documentation necessary how everything has happened. So just understanding your own system to building that digital twin, I think, is quite valuable. But then when you make changes, it's also valuable to make them first in the digital twin and make sure that those changes are good.
And keeping those in sync as much as possible,
Exactly,
because these systems last a long time, right?
Exactly. Like the 25-year sort of investment cycles with these sort of critical infrastructure.
So I just have one more question before we get to the audience questions, and it's really about, if I'm an organization and I want to develop a digital twin capability, what do I need to do? What do I need to prepare?
So of course, we develop digital twins from our platform. So it's relatively straightforward for us to build a digital twin of any payment system or financial market infrastructures, and we have a number of those already. If you want to build them yourselves, well, it's mostly around engineering resources, maybe some data science subject matter expertise as well, because a lot of these systems have very specialized algorithms. If you have bought it from a vendor, maybe actually you don't know how exactly everything works under the hood. So maybe also sort of asking your vendor whether they provide digital twin solutions. But at the end, it's a very specialized software engineering, data science, subject matter expertise, sort of like a circle that you need to have. If you're running these sort of like large, maybe the largest critical infrastructures might have the resources in house to build these systems, and some have done so. But if you don't find those resources yourself, that's sort of where we come in.
Great, thank you, Kimmo. I'm going to invite Anthony back in now to facilitate some questions from the audience.
Yeah, thanks, Martin, and thank you both. That was really interesting session. I've opened that to the Q&A widget to all the participants. So if you'd like to upvote some of the questions, I doubt we'll have time for all of them. But if there are ones that you'd like answered in particular, then by all means jump into the Q&A widget and upvote them. So I'll start picking off a few of them. One of them, ones at the top, has had 4 votes already. Kimmo, building an accurate digital replica of a complex system like payments seems challenging. What are some of the biggest obstacles you faced? And how do you keep the twin current as the actual system changes? It's a good question.
Yeah, I think the latter part of the question, I think we already answered in a way. That change management is to make the change first into the digital twin before into the real system. I think the biggest obstacles we find are related to availability of information around the nitty-gritty details of the system, because in these software systems, the devil is in the details. So very small changes in how an algorithm works can have very large impacts on how the whole system operates. So getting that information around how does the system actually work is I think usually the biggest challenge, because without that information we can't replicate it, and quite often that's also part of the where a lot of value comes in, because as a part of the process of replicating, you actually start to understand how does the system operate on the detail level, and that's, I think, one of the values that building that digital twin really brings.
Thanks, Kimmo. Martin, was there anything you wanted to add to that, or?
No, that's fine. Thank you.
So jumping into another one, another popular one, I guess to the both of you, smaller banks and processors may lack the capability to develop digital twins internally. Could they still benefit through some kind of external access or consortium model? And that's open to both of you.
So, I'll start here, Kimmo. In Canada, of course, the banks are part of the Canadian Payments Association, which is also known as Payments Canada. And we have a governance process for them to be engaged in the activities of the payment system, whether that's through modernization or in the case when we recently changed our high-value payment system to a real-time gross settlement system, we used digital twins at Payments Canada to understand what the liquidity impacts would be to the various banks who participate in that real-time gross settlement system. Now, of course, the smaller banks have often a clearing and settlement relationship with the larger banks first before those payments would pass through these gross settlement systems. However, our governance mechanisms as an organization allow for the voice of smaller banks to be heard as we go through these modernization programs. Yeah, so I think definitely, and we have we also have I think on our website an example. You'll be working together with UK Finance to propose new features for the CHAPS. So that's an industry consortium model of running simulations of how the payments could be settled differently in UK. Liquidity is a network problem, so in a way you need to have everyone's like flows in order to optimize it. So also for that liquidity optimization, it's, I think, very important to do that on the whole network level. The same thing with the CBDCs is that I think banking systems, and we have a number of engagements with different banking associations on a industry like a consortium or national level to help understand how a sort of future CBDC would work for them, and for how the whole system would work, and what kind of issues it might bring, and what kind of topics should be brought into the attention of the central banks that are building those CBDCs. I think there's a lot of sort of consortium models that can be thought of for different parts, CBDCs, liquidity optimization, modeling of like industry-wide disruptions as well, stress tests, rather than each bank doing them separately, because it's difficult to understand, because you don't know what's happening in the rest of the network. But I think all of these are better done on the industry level.
Thanks both. I think that answers that question very well. So I guess it wouldn't be 2023 without a question related to AI. So I'll go ahead and ask it, which is, how can AI play a role in building digital twins of payment systems?
I think AI can be very much used in the optimization of those systems. How do you coordinate, like the liquidity is at the right place at the right time across the system. And this is what like a lot of the large value payment systems do in the liquidity saving mechanisms, is try to coordinate that liquidity is optimally used. We're doing a lot of that is not related to AI really, but like also on I think there's a question on AML and fraud as well. I think AI is something that can be widely applied to be able to detect anomalous payments. Also on the large value payment side, like we have a couple of large value payment system clients that are running AI-based algorithms to detect anomalous large value payments, but also of course on the retail level to look at different scams and frauds and mule accounts and identification of those.
I will say, AI, the first question I like to ask is, well, what do you mean by AI? Currently, in the last 6 months or so, it's generative AI and large language models, which has grabbed the headlines around the world. And, while that is popular now, AI has been employed for many years before that, as Kimmo indicated, detecting anomalies against base data sets, beyond the simple statistical classification of data. However, I'm guessing, I'm implying that this question is also about what's happening in the AI marketplace with generative AI and large language models. And I'm not going to speak so much on the opportunities, because I think Kimmo mentioned how useful it is in the digital twin space. But I will put in a plug here for considering the risks of AI for financial services, particularly when it comes to cybersecurity. If you're interested in hearing about that, I'm speaking at a panel at Sibos in Toronto in September. So please come and participate in that as well.
Thanks, Martin. A good and very fair plug. I think that was very relevant as well. I think we've probably got enough time for one more. Existing rules tackle fraud and AML. Could digital twins identify the need for new rules by modeling anomalous scenarios not caught today?
Yeah, actually, I had this conversation just last week about it was in the context of CBDCs, and when CBDCs come, and like they're going to be in a way like faster payment systems or instant payment systems. So it would be plausible that the fraudsters find ways to steal people's CBDCs or use the CBDC system to mule around payments that are like fraudulently acquired from some other electronic system, and then be able to build these digital twins to be able to start to model different types of new schemes that might be enabled by programmability or other features that the CBDCs would have, and start to in a way play them in the system of that digital twin. And like a digital twin, you can be a fraudster there, right? So you can one of the agents can be a fraudster, and you can start to devise different new methods there that you can test out how they would work in that digital twin environment. That's actually the reason this digital twin. So like when we were working with the national laboratories in the US to build these simulation models on attacks on critical infrastructures. So my plan was that usually they would put everything into open source, and my plan was that once they put that into open source, I would build like FNA as a company on that open source software. But of course, like someone got the idea that maybe we shouldn't put into open source software that allows you to simulate attacks against the critical infrastructures. So the same way, with this sort of like maybe we don't want the fraudsters to have access to these digital twins to test different types of new schemes for laundering money or losing track of different chains of money trails.
It's awesome. Thanks, Kimmo. And thanks, Martin, as well, for joining F&A today. I think we've come to the end of the session now. Apologies for all those that didn't get their questions answered. We'll pop up on screen details of how to get in touch with our speakers. There's also a ton of links as well that's been put in the chat. We've referenced a number of case studies, research papers, other interesting links as well. So I'm sure you can find some of those useful and interesting. We've got a number of events coming up next, additional broadcasts, which of course you can access via the F&A website at fna.fi. Of course, as Martin mentioned as well, register early for the payments, register very early for the 2024 Payments Canada Summit that's happening in Toronto in May. And thank you to all of our guests for joining us today. It's been a really good session. The broadcast recording will be sent to all of our attendees after the session, so don't worry if you've missed sections. Otherwise, yeah, we look forward to welcoming you to the next session. Thank you.
Thank you. So great. Thanks, Martin.
Thank you very much. Take care, everyone.
Thanks for the good questions.